Okay, let's dive right in. So you've done all the heavy lifting. You've estimated the cash flows, you've picked a discount rate, and you've valued a business. You think you're done, right? Well, in today's explainer, we're going to cover those crucial final steps. How you get from that big business value number to the value of equity, which, let's be honest, is the number you, as an investor, really care about.
So you've got this value for a business's operating assets. You might be tempted to call it a day, and hey, a lot of people do. But that number is just the starting point. It's not the final destination an investor needs to get to. To get to the number that really matters, the true value of an equity stake, we've got to tie up 4 key, let's call them loose ends. These are the critical adjustments that bridge the gap between the value of the business as a whole and the value of your stock.
So, here's the game plan for today. First, we'll talk about valuation's unfinished business. Then we'll tackle those 4 key adjustments: the curious case of cash, how to navigate cross-holdings, the hunt for other assets, and finally, what debt to subtract. And then we'll put it all together to get to that final equity value. Sound good? Let's go. Okay, so you've done your discounted cash flow analysis. The number you have in front of you, that's the value of the company's operating assets, the stuff that actually generates the cash. But to get to the number that an equity investor, like you, cares about, well, we've got some mopping up to do. And this mop-up process really boils down to 4 key steps. We're going to start by adding in the value from non-operating assets, things like cash and those tricky cross-holdings. We'll also do one last sweep for any other hidden assets. Then we flip to the other side of the balance sheet and subtract all the claims against those assets, which for the most part means the company's debt. All right, first up on our list, cash. Now, this should be the easiest part, right? A company has $100 million in cash, you just add $100 million to the value. Simple. Well, hold on a second. It's not always that straightforward. The real value of a company's cash, it totally depends on the company holding it. It really all boils down to one thing. Do you trust the management? Think about it. If you've got a company that consistently messes up, earning returns below its cost of capital, you're probably going to discount its cash, right? You just don't trust them not to waste it. But on the flip side, what about a star performer? A company that's knocking it out of the park, especially in a fast-growing market. You might actually value that same cash at a premium. Why? Because in their hands, it's not just cash, it's a strategic weapon for future growth.
And there's actually a fantastic term for this, which I love: the stupidity discount. You literally apply this to companies with such a terrible track record that you're just convinced the managers are going to find some new, creative way to burn through that cash. It's not that the dollar isn't a dollar, you're just pricing in the high probability of a bad decision.
And hey, this isn't just some abstract theory. The market data backs this up big time. A study looked at U.S. companies and found that, yeah, on average, a dollar in cash is worth about a dollar. No surprise there. But when they dug deeper, they found something fascinating. For mature, low-return companies, the market valued that dollar at just 69 cents. Ouch! But for young, high-growth companies, that same dollar was valued at a premium, $1.22. It's proof positive that when it comes to cash, context is absolutely everything. Okay, let's move on to our next loose end. And this one is an absolute minefield. We're talking about valuing a company's cross-holdings. These are the stakes, big and small, that one company owns in another. And let me tell you, this is often the trickiest, most frustrating part of the whole valuation process.
In fact, the frustration is so real that cross-holdings are often called the black hole of valuation. It's this area where the accounting rules get so messy and inconsistent that trying to figure out what these stakes are actually worth, just by reading the financial statements, feels almost impossible. And here's the reason it's so darn confusing. The accounting rules change depending on how big the stake is. So for a tiny passive investment, you might only see dividends on the income statement, and the balance sheet shows what they paid for it maybe 10 years ago. Useless. Take a step up to the equity approach, and you see a slice of the net income, but it's still not the whole picture. And then, for a majority stake, the company has to consolidate. That means they pretend they own 100% of the other company, and then they try to back out the part they don't own with this super confusing line item called minority interest. See what I mean? It's a total mess. So, in a perfect world, here's how we do it. We'd value the parent company on its own. Simple enough. Then, we'd do a full, separate, intrinsic valuation for every single one of its holdings, and just add up the value of the percentage we own. Easy, right? Yeah, right. The problem is, in the real world, we almost never get the detailed financials for these subsidiaries that we'd need to do a proper valuation, so we're forced to use shortcuts. So what are these shortcuts? What can we actually do? Well, here are two really practical approximations. First, if the holding is in another publicly traded company, you can kind of cheat and just use its current market price. Look, it's not a pure intrinsic value, but it's often your best and most realistic option. Second, if the holding is in a private business, you can take its book value and then apply a price-to-book multiple from similar public companies in that same industry. It's an estimate for sure, but a lot of the time, it's the best you can do.
All right, we've wrestled with cash and survived the black hole of cross-holdings. Our third step is like a final look around the room. Are there any other valuable assets lying around that we haven't counted yet? This is our last chance to sweep them up and add them to the pile.
But, and this is the big one, there is one critical rule here. You cannot double count. I'll say it again. Do not double count. Any asset that's already generating the cash flows you've so carefully forecasted and discounted, you can't add it again. So that means you don't add the value of a factory that's making your products or the real estate value of your corporate headquarters. What you are looking for are the rare, truly unutilized assets, things that have value but aren't contributing to the cash flows yet. They're not common, but you've got to check.
Okay, now for our final cleanup step. We've added up all the operating assets and the extra non-operating assets. Now we have to subtract all the claims against them. To figure out what's truly left for the equity holders, we need to be really clear about what we count as debt.
And it's really important to get this right. When we talk about subtracting debt in a valuation, we're using a much broader definition. This isn't the same narrow definition of debt you'd use for calculating the cost of capital. Here, debt means all obligations, basically anything that represents a claim on the company's future cash flows.
So what does that actually include? Well, you start with the obvious stuff, all the interest-bearing debt from banks and bondholders. You also have to subtract all of a company's lease commitments. We treat those as debt now. But this is also your last chance to account for anything else that might be keeping you up at night. For instance, if you're valuing a tobacco company, you're probably worried about future lawsuits, right? You have to try and estimate the expected cost of those potential losses and subtract that from your value too.
And just like that, we've mopped up all the loose ends. After that big DCF valuation, we've carefully adjusted for cash, navigated the maze of cross-holdings, checked for other assets, and subtracted all the debt. Now, finally, we can put it all together and get to our final equity value. So, here it is, the entire journey on one slide. It's a simple, logical flow. We start with the value of the operating assets. That's our number from the DCF. Then we add the value of all the non-operating assets. Cash, making sure to adjust for management quality, cross-holdings, using our best available estimates, and any other unutilized assets we found, being careful not to double count. From that total value, we subtract all the claims, the debt, and other liabilities. And what's left over? That's it. That's the value of the equity. That's the number that investors like us really care about.
So you see, getting from business value to equity value, it's so much more than just a mechanical, box-checking exercise. Every one of those adjustments tells a story. How you treat a company's cash, that reveals how much you trust its management. How you navigate its cross-holdings, that exposes the true complexity of the business. This whole process, it isn't just about finding a number. It's about uncovering the hidden truths of a company, its management, and its future.